Have you ever heard the word investment but weren't really sure what it meant? Today we're breaking it all down, defining what is an investment, why do people invest, what do they invest in, and some of the risks associated with investing. So let's get started. So what is an investment? An investment is anything that you put your time, money, or resources into with the expectation that it will provide a benefit for you in the future, whether that's making you more money, saving you time, or providing some type of other benefit to you. So investments generally fall into one of two categories. The first category is traditional investments, and this is where you put money into something with the idea that you'll generate even more money at some point in the future. That would include things like stocks or buying pieces of companies, bonds, so lending out money and getting paid interest over time, real estate, so buying a property to either rent it out or sell it for a profit in the future, businesses, so either making your own business or investing in someone else's business, or even cryptocurrency, so buying digital money with the idea that the value of that money will go up over time. The second category is what I'll call non-traditional investments, and these are things that don't necessarily make you more money, but may provide you with some type of alternative benefit, such as personal, relational, or societal. And this would include things like getting an education, which may provide you with skills that you need at some point later down the line. May include things like taking someone out for dinner, which would improve your relationship, or something like volunteering at a community center, which would provide societal benefits. Now, for the purpose of this video, I'm going to stick to talking about traditional financial investments. So why do people invest? They invest for a number of reasons, but I'll hit on a few key points here. The first reason is inflation, and this is the idea that the value of money goes down over time because the prices of goods and services goes up over time. So let's just take, for example, you go to a coffee shop and you want to buy a cup of coffee, and in today's terms, a cup of coffee costs $5. Now let's just say that 5 years from now, you go to that coffee shop and the price of a cup of coffee is $10. In today's terms, if you had $100, you could buy 20 cups of coffee. But let's just say you didn't do anything over the course of that 5 years with that $100, maybe you just left it under your mattress, and you pulled it out and you tried to use that $100 to buy cups of coffee, you could only buy 10 cups of coffee because each one costs $10. Because you can buy fewer cups of coffee in the future as you can now, this reduces your purchasing power, or how many cups of coffee you can buy, and this is what's meant by inflation. Another reason is what we call compound interest, and this is the idea that your money can go out and make you more money, and then that money can make you even more money, creating what we call a snowball effect. So let's just say, for example, you have $100 and you invested at 10% over the course of a year. At the end of the year, you'll have $10 more than you originally had, or $110. Now that $10 the following year can make you even more money. So invest that at 10%, and the following year you have another dollar, while your original $100 goes out and makes you 10% or $10. So the last reason I'll cover, and by no means is this an exhaustive list, is retirement and financial freedom. The idea here is that you build up enough wealth so that one day that money goes out and works for you so that you don't have to when you don't want to. So what are the risks of investing? There's 5 risks that I'll cover here, but by no means is this an exhaustive list. So the first risk that I'll cover is market risk, and this is the idea that the value of an investment you own could change due to things like the economy or global events or an overall investment trend. So let's just say that you own a stock and that stock today is worth $100. Well, tomorrow it could be worth $120 or $80. Nobody really knows, but the idea that the price could change due to a non-company specific event is what we call market risk. So the second risk is what we call liquidity risk, and this really means how quickly can you turn your investment into cash. So let's just say, for example, you have a stock and a piece of real estate. That stock you could sell in a matter of seconds, where that piece of real estate you would have to sell over the course of maybe several months. So in this case, the stock is more liquid than the piece of real estate because that stock can turn into cash more quickly than that piece of real estate can. The third risk is what we call going concern, or put more simply, business risk. And what this means is that if a company you invest in goes bankrupt, then your investment could be worthless. So the fourth risk is credit risk, or what some people refer to as default risk. And what this means is that if you lend out money, maybe the person that borrowed money can't pay you back, or they won't pay you back for whatever reason. So the fifth risk is fraud and scam risk, and what this is about is some people might try to trick investors with fake investment opportunities. So really what they're trying to do is just take your money and not give you any money back in the future. Now these aren't all the risks that you'll encounter, but these are some of the biggest ones that I wanted to highlight. So let's recap. An investment is something that you put your time, money, or resources into, expecting a return in the future. Why do people invest? People invest to fight inflation or retire. And what do they invest in? They invest in things like stocks, bonds, and real estate. Some of the risk of investments are things like market risk, liquidity risk, or fraud risk. Now, if you found this video helpful, please make sure to like and subscribe. And if there's any other content you want me to cover, please drop a comment. Until then, we'll see you in the next one.